Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see step by step whether it really deserves a spot in a serious dividend portfolio. Today we're examining Becton Dickinson, ticker BDX, a global leader in medical devices, diagnostics, and high-volume healthcare consumables that sits at the heart of hospital and laboratory workflows worldwide. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if BDX is attractively priced today. How this company makes money. First question, do I clearly understand how Becton Dickinson earns its money, and does that business model make sense for dividend investing? Becton Dickinson makes money by selling essential medical and laboratory products that hospitals, clinics, and labs use every day, where reliability, scale supply, and workflow integration matter as much as the product itself. Cash flow is driven by recurring consumables demand tied to patient throughput and clinical necessity, not by consumer branding or discretionary spending trends. The core earnings drivers are healthcare consumables at scale, high-volume, repeat purchase categories consumed continuously in routine care delivery, tying demand to patient throughput and standard clinical workflows rather than short product cycles, installed base and pull-through. Once a system is placed and validated inside a hospital or lab, it drives ongoing purchases of compatible consumables and related supplies, creating durable repeat revenue and high customer stickiness. Diagnostics and lab workflow exposure. Participation in diagnostic and laboratory operations where consistency and uptime are critical, supported by ongoing testing needs and operational requirements that tend to be steadier than discretionary categories. Operational execution and customer integration, manufacturing scale, quality systems, regulatory discipline, and distribution reliability create competitive advantages that support long-run relationships and recurring revenue across healthcare cycles. In other words, Becton Dickinson is not a black box. It's a high-repeat, workflow-embedded system tied to essential medical consumption and the ongoing functioning of healthcare delivery. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. Becton Dickinson doesn't just clear that bar, it shows the classic stair-step dividend pattern long-term investors want, with 50-plus consecutive years of dividend increases that qualify it as a Dividend King. Annual dividend per share rose from roughly $1.6 in the early 2010s to about $4.1 most recently, with no visible reset or panic cut. That shape signals a payout backed by repeatable cash generation and a culture that treats the dividend as a standing commitment, not something to dial up only when conditions feel easy. Step 1 passed. Becton Dickinson behaves like a genuine dividend eagle, with a durable record of increases that supports its candidacy as a dividend growth holding. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, Becton Dickinson's sales grew from roughly the low $12 billion range in the mid-2010s to about $22 billion most recently. The path isn't perfectly smooth, and it shouldn't be for a company influenced by hospital and lab purchasing cycles, pricing pressure, and portfolio transitions, but the long-term direction is clearly higher. The uneven patches are the stress test. When utilization shifts or budgets tighten, revenue can wobble. The key is that BDX continues operating from a much larger revenue base than a decade ago, showing the franchise is durable, sales growth past. Becton Dickinson now operates off a materially larger revenue base than a decade ago, which supports dividend growth. Second pillar, profit growth, the fuel. Profit trends reinforce the same message with added conviction. Over the last decade, profits build from roughly the $6 billion range in the mid-2000s to around $10 billion most recently, with a lift into the later years, a couple of uneven stretches, and then a renewed step higher. The driver is not a new fad segment, but better economics on a growing installed base. Recurring consumables pull-through, manufacturing scale, and ongoing cost discipline. That looks durable rather than dependent on a single perfect year. Profit growth past. An expanding profit base protects the payout and funds future increases. Third pillar, net income. True strength. Net income starts in roughly the $1 billion range early in the decade, climbs to a peak of around $2.5 billion, and then settles into a more stable zone in the $1.5 to $1.7 billion range through the most recent years. The profile includes a notable mid-decade dip, a meaningful rebound, and then a steadier stretch. Exactly what we want to see. Evidence the company can absorb volatility and keep the underlying earnings engine intact. Net income past. A resilient underlying earnings profile reinforces that BDX's dividend growth is supported by real operating staying power, not a temporary tailwind. Fourth pillar, dividend payout safety, protecting passive income. For most of the period, BDX's payout ratio sits in a workable range, often clustering around the 50 to 70% zone. Then you see the outlier, a one-year surge to roughly the mid-200% range, followed by a move back toward normal levels, with one more elevated year around 100% before the trend settles again. That spike happens when earnings are temporarily compressed while management keeps the dividend on its intended trajectory. The denominator weakens, not the dividend commitment. What matters is what comes next. The payout ratio normalizes back into a sustainable band as earnings recover, showing coverage has been restored. Dividend payout safety past. Despite temporary distortions during earnings dips, the payout ratio has returned to a sustainable range, supporting the view that the dividend is affordable under normal conditions. Fifth pillar, debt burden, avoiding traps. Becton Dickinson uses debt, and that's expected in a capital and R&D intensive business. The 10-year debt ratio begins around 0.70, steps down into the low 0.6s and high 0.5s, bottoms around 0.51 in the middle years, and edges back modestly into roughly the mid-0.5s more recently. That's managed structural leverage, not a creeping problem, and the improvement over the decade is the key signal. Debt burden past, leverage is the key constraint to monitor. But the improvement trend across the cycle lowers the odds that the dividend becomes a near-term pressure point. Becton Dickinson's overall financial score comes in at 96, very safe in our framework, signaling a balance sheet and earnings profile built for durability across multiple market environments. Does it fit our plan? This is where we move from, is it a good company, to what job should it have in my portfolio? MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength, to classify stocks as growth eagles, balanced eagles, or income eagles. Becton Dickinson's MaxRatio is 4.42, which places it firmly in the balanced eagle bucket. With a dividend yield of 2.67%, BDX offers meaningful income today without drifting into high-yield territory. The appeal is in its overall profile, approximately 30% cumulative dividend growth over 5 years, a 5-year average payout ratio of around 62%, and 54 consecutive years of dividend payments that reflect management's commitment to shareholders through healthcare cycles and operating complexity. In practice, Becton Dickinson is a balanced core holding, a solid starting yield paired with a long runway for annual raises, built on installed base economics and recurring consumables demand that repeat year after year. It fits investors who want steady dividend compounding from a high-quality healthcare franchise and can accept some earnings variability tied to integration, pricing, and utilization trends. Is the stock undervalued today? Here the signals are broadly supportive. Versus peers, BDX screens as undervalued in the Max Dividends app, meaning the market currently assigns it a cheaper than average valuation relative to comparable medtech, healthcare supplies, and diagnostics businesses. Versus its own history, the current PE is around 25 versus a 10-year average near 58, though that historical average is skewed by a major outlier spike earlier in the period. The practical takeaway is that valuation looks depressed, but the margin of safety should be underwritten by business quality rather than assuming a fast re-rating to that unusually high historical average. On yield, BDX pays about 2.67% today versus a long-term average near 1.73%, meaning the starting income is above what investors have typically received over the last 15 years, a more generous entry point than usual for this company. Analyst consensus sees meaningful upside, with an average 12-month price target implying roughly 26% upside and an overall lean toward buy, reflecting confidence in margin trajectory and operational execution. Final decision. Taken together, Becton Dickinson looks like a high-quality dividend compounder where valuation and yield are both providing some assistance. Undervalued versus peers, trading below its own long-run average multiple, and offering a yield above its historical norm. That is a more supportive setup than usual for a Dividend King level franchise. For conservative dividend investors, BDX makes the most sense as a balanced Eagle Core holding. A solid 2.67% starting yield paired with a 50-plus year dividend culture and the potential for that payout to keep rising steadily as BDX executes on its installed base, consumables pull-through, and operational priorities. Subscribe for more analysis. This is not investment advice.